Hello, and welcome to the February 2024 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joined with me is Mark Zavitz. Today, we will be discussing our model portfolio performance and then going over new tax filing requirements everyone needs to be made aware of. So let's get started. So we've started off the year very strong. Our models, specifically those with heavier stock allocations or weightings, are doing very well. Mark, give us your 2 cents on what's driving the market right now. And, in previous videos, we've talked about how we think at some point soon bonds are going to start doing well because rates are going to be coming down, but maybe give us your take on that as well, what you see happening.
Okay, thanks, Greg. Well, the equities, the stocks in everyone's portfolio are driving the returns. The bonds are, as you mentioned, the bonds are still they're not struggling, but they're not adding a lot of value. So we're kind of in a holding pattern with interest rates, and interest rates are, are flat, which is good. So we're not incurring really any capital losses on the bonds. We're earning the interest, we're earning the coupon each month from the bonds, but the capital gains from falling interest rates has not occurred yet, and will likely not occur, I don't think, and it'll start probably sometime late this fall, maybe the summer, or excuse me, late the spring, or possibly the summer. So there will be some very good returns coming from fixed income from the bonds, but it looks like that's going to occur in the second half of the year. For the time being, the equities are on a tear. And as you can see with the growth portfolio, the one-year return on the growth portfolio, which has about 85% stocks, 85% stocks, after fees is 13.37%. So that's excellent. The moderate portfolio 10.57 after fees, and the conservative portfolio 872, the very conservative 682. So, the very conservative portfolio only has a 1/3 slice of stocks, 2/3 fixed income, and that's the difference. That portfolio generated 6.8% after fees. The equity, or the growth portfolio, excuse me, which is predominantly equities, returned about double, a little more better than double. So all in all, fantastic performance. And I expect the conservative and the very conservative portfolio with the additional bond weightings to not necessarily to catch up, but to perform on a better basis, on a relative basis for the second half of 2024.
I agree 100%. At some point, we've been saying this for a while, but at some point when interest rates eventually do come down, it's looking like we didn't hit a recession in Canada with GDP numbers that just came out this morning. But it's like we were so close to having 2 negative back-to-back quarters. Like it was on the cusp of us being in a recession. And you look at how strong the States is performing. If the state wasn't as strong, then we would for sure have been in a recession. And so at some point, the fact that we are so interest rate sensitive in Canada to the rise in rates, and it takes 12 to 24 months for a rise in rates to affect the economy. Well, we've been at this high interest rate level for a year plus now. It's making its way through the economy. It's affecting the consumer. And you can see it in spending habits. You can see in industry. You can see in all the things that drive revenue for stock prices. So I think, to Mark's point, we're going to see rates come down late spring, beginning of summer in Canada, and we'll probably see anywhere from between 4 to 6 rate decreases. But if we see 4 rate decreases, instead of seeing 25 basis points to kick things off, I wouldn't be surprised if we saw perhaps a 50 basis point decrease. All hinging, though, on economic data and what goes on over the next 2-3 months.
Yep.
So let's talk about Bare trusts. Trust, everyone's favorite topic. You might be thinking to yourself, why do I care about tax rules for trusts? I don't have any trusts, nor will I ever open up a trust account. And what the heck is a bare trust? Unfortunately, for many of you, new tax rules have come into effect. Thank you, government. End of 2023, and these tax rules are super far reaching. I'll try to explain this in plain English. Individuals who hold assets jointly with a non-spouse, or they hold assets on behalf of someone else, can now be deemed to be in what's known as a bare trust relationship. Basically, the federal government and the CRA have for years been unable to successfully track beneficial ownership of assets that are either jointly held or held on behalf of someone else. And so people forever have been taking advantage of the ownership structures over time, and they've been giving themselves tax advantages, but it's well known in the system. Accountants take advantage of it. Now, to put it simply, the governments want taxpayers to declare how an asset is owned when it's jointly held or held on behalf of someone else. And if there is a relationship of jointly held assets for tax advantage reasons, this is what they consider to be a bare trust or bare trust relationship. Now they want additional disclosure in the form of a trust tax return filed by this person who is the primary beneficial owner of the asset, also now known as a trustee. So who does this affect? Well, in general, it should not affect assets that are held by jointly between spouses, which is how the majority of joint assets are held in a family between spouses. A bare trust situation occurs when an asset owner, in this case known as a trustee, holds legal title to an asset, however, is not the beneficial owner. And that is the important distinction. So if you see this slide, for example, this is most typically found in real estate when a corporation owns legal title to a property, but the property is owned beneficially by someone else. However, there can be many other forms of bare trust arrangements. For example, when an adult child is on their elderly parent's bank account or their investment account, if the elderly parent is the one to report all of the income and all of the cash from the investments form part of their estate upon passing, the child is only on legal title, and in that case, a bare trust situation or relationship exists. So what does this mean to you as the client? Well, if you hold anything jointly with a family member other than a spouse, the CRA may consider this to be a bare trust relationship and as such require additional filing. Or if you're a grandparent, for example, who has a trust account set up for their grandkid, this could also be considered a bare trust relationship. So you'll have to file additional trust tax returns. Oh, great. Now, before you think about your personal situation and potentially panic, there are some exceptions to the rule. The main one being that assets held jointly or on behalf of someone else at a value of less than $50,000 are exempt from the new filing requirements. So using the previous example, an adult child on their elderly parent's bank account or investment account, if that account over the 2023 calendar year was under $50,000 of value for the full calendar year, then there's no trust filing requirements to worry about. But if at any point over that calendar year, the joint account surpassed $50,000 in value, then a bare trust relationship could have been established, and the CRA is going to want a trust tax return filed. Now, to make matters even more complicated, filing requirements for all trusts, including newly deemed bare trusts from bare trust relationships, are 90 days after calendar year end, meaning you have a month to file your trust tax returns before potentially incurring a penalty, because we're at the end of February right now and April 1 is about a month away. Personal tax returns are due a month after that. So if you file your trust tax return and you file it sometime in April when you file your personal tax returns, well, you're already late. So you might already incur a penalty. What could that penalty be? So what happens if you fail to file a bare trust tax return and the government is able to prove that a bare trust relationship exists? Well, the taxpayer could be penalized $2,500 or up to 5% of the highest market value of the account. So let's put this into perspective. Imagine you're a senior and you've added your adult son to your $1 million non-registered investment account. Now it's held jointly. And this was just done for estate planning purposes years ago. It happens to fit the CRA's criteria, or the government's criteria, of being a bare trust relationship and as such being a bare trust. Unaware of this filing requirement, you just don't file. Well, this could cost the parent, the senior parent, for every year they fail to file, up to $50,000. Like, talk about how ridiculously punitive this is. Mark, how do you feel about this? I mean, you had an interesting perspective. Like, how are people supposed to know about this? This just feels kind of ridiculous.
Well, Greg, you're absolutely spot on. The challenge for many of our senior clients that have added adult children to their accounts, to their investment accounts, and most of them are definitely over $50,000 of value. The challenge is going to be that a lot of them don't use accountants. They have never used accountants, and they're not going to have any idea that this particular adjustment, this change by CRA even exists. They don't know. First of all, they don't even know what a trust is. They have no idea that they don't know what a trust is. They don't know they have a trust. They certainly don't know they're supposed to file a trust tax return. And there's nobody to tell them. Because many of these people don't have accountants. Their income taxes are very simple. They just have 2 or 3 slips, and their adult child does their taxes, or they still do their own taxes online, or they just get a friend to do their taxes, or someone from the nursing home comes in and does the taxes, and nobody's going to know that this particular issue even exists. So it's a big problem.
Yeah, it's not like as if the government of Canada sent out a letter to all taxpayers notifying them of this important tax change.
No.
It's a trap, right? It feels like it's a trap. It feels unfair. There are a few other things that the government does that are tax trap related, such as posting incorrect TFSA contribution limits online when you log into your CRA My account. But this just feels like they've gone way too far.
Yeah, agreed.
What do you do if you suspect you might need to file a trust tax return? If you're not sure what to do, you can contact us. But what we recommend you do is reach out to an accountant. Like, if you've watched this video, then you try to educate yourself and you think you might be in a position, you could talk to us about it. We'll happily talk to you, but we strongly suggest talking to an accountant, primarily one with a CPA or CA designation, because those accountants are likely to be in the know about this trust tax filing rule that's come down the pipeline, and who may or may not fit the mold of having to file as a requirement. If you just go to like an H&R Block or a Liberty Tax, or I don't know who else you might go to, that person in the nursing home, as Mark was referring to, there is a good chance that they'll have no clue whatsoever about this filing requirement. And we don't know how it's going to shake out. If you'll be able to get away with not filing, or the person will just get away with not filing, and then say 4 years down the road, the CRA comes knocking and says, oh, by the way, it's deemed to have been a bare trust relationship, so you're a bare trust tax filer. You should be filing a trust tax return, and you owe us 5% of the value of the account times 4 years plus interest. And that's what I'm most worried about. So Obviously, good news for markets, for market participants, for anyone who's invested. Bad news for those who are filing taxes, specifically anyone who holds assets jointly or on behalf of somebody else. But thank you so much for tuning in and listening to our update. Thank you again. If you've stayed this long, Mark and I really appreciate it. And we look forward to sending you our next update at the end of March. Here's the disclaimer. Thanks so much.
Take care, everyone.